Hey guys, Cam McClellan.
Al Lewis, and welcome to today's workout of the day, guys.
Wealth Wild.
Guys, over the last couple of days, we've been talking about, what are we talking about?
MAP process.
MAP, specifically the M, market in the MAP process. And yesterday we talked about the five of the key points we look at and focus on when we're determining any given market area. One of the really key ones that we probably thought we'd touch on in a bit more detail is the last 2 years growth rate in a given city. And why that's so important. So what do people typically do, and when does the frenzy happen in the market? It's when the media get involved. The media get involved when the market's been ticking along, improving steadily, maybe over 12 months. When the market's getting near the point it's overheating, the media say good things, people jump in and say, well, I need to buy a property. Now's the time I'll miss out. I've got to quickly jump in the market. And guess what, guys? They're mistiming the market. Supply and demand are the big factors at play there. We're going to show you through something we worked out. As we said years and years ago, we've heard it before, we had to create this ourselves. It wasn't out there for us, so we put a little time and effort in to find out and work out our own strategies. So, Ken?
Al's little brother Matt is also one of our business partners, is CEO.
He's a very smart guy.
Does think he's a smart guy. He's pretty smart, but we've got him covered. And Matt and I spent a good day in the boardroom basically going through, and the question I posed to Matt and what I wanted to be able to provide to people was basically an understanding of the market cycle clocks. Everyone's seen the market cycle clock in the magazines and those
TikTok.
sort of things.
TikTok.
And while knowing that a market, for example, might be at the start of recovery, or it's in a stagnation period, or it's in a correction period, I wanted people to be able to understand and identify what it's going to do next. So, more importantly, I wanted to be able to illustrate to people the danger time when they should not be investing in property, because a lot of people love hyping property up and saying it's all happy days, but there is risk involved. We're not buying lollipops, and you can buy at the wrong point in time. Long term, fantastic, but if we can try and avoid buying when the market's going to do a nosedive, on average, the market's going to have a good 8.7% growth as it has it.
So, guys, 2 days in a row, 16 hours per day, charts for the last 50 years of each capital city in Australia, the population more than 1 million.
It's painful.
Isn't a fun day?
No, that's all right. So instead of you guys having to do that, I want to give you a simple tool that you can look at by understanding the last couple of years' growth rates and understanding the current point in the market, and you'll be able to identify when you should not invest in the market. So Warren Buffett, arguably one of the world's greatest investors, one of his sayings is, be fearful when others are greedy, and greedy when others are fearful. So I'm going to explain to you how to be greedy when others are fearful, and that's how we invest. So let me rip into what we call the developer's activity chain. Let me make something clear. If you see this anywhere else, they've stolen it from me. Mine. Okay. Does that make sense to you?
Oh, absolutely.
There's demand against supply. So a lot of people throw around the term supply and demand. Not many people truly understand what supply and demand is in any market. So demand, population growth. So the amount of people coming into any capital city market against. The opposing force to demand is supply. So the amount of affordable housing getting dumped onto the market at any point in time. And that's currently and future plans, so through the acquisition and development stage. So I'm going to run you through why price movements occur and how you can identify supply and demand as it changes. Now this, if we put it over, so this is the standard, say 7 to 10 year cycle in the market. And there's 3 stages through any cycle. So there's stagnation phase, the next is a growth phase, and after a growth phase, lo and behold, we get a correction phase. Now this occurs, this is history repeating, and there's a reason for it. It's not that it just happens to repeat, and history just happens to repeat. It's because of the developer's activity. And this is what the mum and dads and the punters don't understand or don't get to see, more to the point, so apologies not talking to anyone. All right, so keeping in mind, we want to identify the time when it's not good to invest in any property. So first of all, I should explain, Al and I are developers, that's our profession, that's what we do. So when we think about developments, and this is going to give you a good indication, so think about developments, medium to high-rise apartment developments, so we build those large buildings with the cranes on top, commercial office blocks, but the majority of affordable housing comes from medium to high-rise apartments and broadacre land subdivision. So when we do a large-scale broadacre subdivision, the timing usually takes 2 to 3 years by the time we go through acquisition, the planning, pre-sales, run the civils, and we've got product we bring onto market. An apartment can take a little bit longer.
But where we've talked about yesterday, guys, was that what we spend most of our time doing is ruling out areas we won't be in.
Yeah.
So we start with everywhere, and we slowly chip away
Yeah.
to a very slight window of properties or markets,
Yeah.
to fit within our spectrum that we look at any given time.
So good point. This is going to illustrate to you how to knock out a capital city market. So how out of the 4 major capitals, how to knock a couple out that aren't good for investment at this point in time, based on what you're going to learn in this.
So we've got supply and demand.
Right. So the point where demand eats into the amount of supply, equilibrium occurs. Now at this point in time, developers like ourselves become active in the market. We start acquiring stock. At this point in time, we start all bidding and we start moving into the same market, and we know all the major developers, and we all sort of move around like a herd, to be honest, and we start acquiring stock. Take into account that it takes 2 to 3 years for us to bring stock to market, whether it be broadacre land subdivision or high-rise apartments. 2 to 3 year period occurs, and until that point in time, there's still enough demand coming into a market which absorbs all the additional stock in the market, until developers like ourselves, and at that point we get, that's a boom.
Boom. So what's happened, guys? The demand is greater than the supply. People at this point weren't buying development sites.
Yeah, correct.
The market was in a lull, it was stagnating. So there's all this supply in the market, a little bit of demand picks up. Guess what? All of a sudden, guys, the demand is outstripped supply. Typical supply and demand stuff. You get a boom. The prices rise. They jump and jump and jump.
So let's think about the amount of time, keep coming back to the amount of time it takes before developers can bring stock to market. Now, it usually takes people, and this is what I was saying before, it usually takes people a year or two of seeing good newspaper articles until the consumer confidence gets up enough and more people at this point in time are buying into the market. What they don't understand is that the reality of the situation is this is a time when developers like ourselves are about to start dumping stock on a large scale onto the market. So we're all trying to achieve a sales rate, because the faster we can get our sales rate and turn over our stock, the faster we can move to another capital city and start doing development again. So what does this tell you when you're trying to knock out a couple of capital city markets? Obviously, I understand that you don't have the insight into the amount of supply and demand going into a city market, because you don't have access to all the major developers' acquisition process and current developments. But what you can identify when you can knock a capital city market out is when a capital city is in a frenzy, when everyone else is being greedy, you should be fearful. Because at that point in time, developers are going to start dumping stock in the market, and that's why history repeats, and why you'll see a price correction after every high growth period. So the things you can identify, and that's what we brought up, the last couple of years of strong growth rates. So we've seen double-digit figures for a couple of years. You should be getting used to the fact that it may be a good time to have a look at another capital city market and take advantage of that good juicy equity that you've acquired, grab it, move into another capital city market that's sitting back here. All good?
All good.
Thanks, guys.
Have a good day.